Quick question. Do you know what's inside your 401k right now? Not roughly. Not, it's a target date fund, so it's fine. I mean, do you know the actual companies sitting inside it this week? Because here's the thing. Sometime in the next few weeks, without sending you an email, without asking for your signature, without you clicking a single button, your retirement account is going to buy a stock that didn't exist as a public company 3 weeks ago. It's going to buy SpaceX. You won't decide that. You won't even know it happened until you check your holdings months from now and see a name you never selected. And the wild part? The reason this is about to happen isn't really about SpaceX being a great company. It's about a rule book that got quietly rewritten this year, and almost nobody read it. Let's go read it together.
SpaceX went public on June 12th, priced at $135 a share. By the end of the first day, it had jumped over 19%, and within days, it touched a high above $225. As I'm recording this, it's sitting back around $185. Already a wild ride for a stock that's barely a week and a half old. Here's a number that matters way more than the price, though. SpaceX sold roughly 4% of itself in this IPO. Just 4%. The other 96%, founders, employees, early investors, that's all still locked away. Not tradable, not touchable. So when you hear SpaceX is worth somewhere north of $2 trillion, understand what that actually means. The real market, the part anyone can actually buy or sell, is a sliver. Something like $90 billion worth of shares, floating around, holding up a $2 trillion price tag. Keep that ratio in your head. Tiny float, massive valuation. Everything else in this video comes back to that one mismatch.
Normally, a company has to prove itself before it gets into the big index funds, the NASDAQ 100, the Russell 1000, the indexes that quietly sit inside almost every retirement account in America. The old standard? 3 months of trading, minimum. Let the market figure out what the stock is actually worth before index funds start buying it automatically. 3 months. That was the rule for years. Then, this past May, about 6 weeks before SpaceX's IPO, that rule quietly changed. The new version says a big enough company can qualify for inclusion in as little as 15 trading days. Not 3 months, 15 days. And there's a second change buried in there that matters even more. The old rules required a company to have a decent percentage of its shares actually trading freely before index funds were forced to buy in. SpaceX, remember, only has about 4% of its shares free. Under the old rules, that almost certainly would have been a problem. That requirement got removed too. I'm not going to tell you what to think about the timing. I'll just point out, the rule changed in May, the biggest IPO in history with the smallest float of any company its size, listed in June. Draw your own line.
Here's where this stops being abstract. Index funds don't have opinions. QQQ doesn't sit in a meeting and debate whether SpaceX is a good investment. If SpaceX is added to the NASDAQ 100, every fund tracking that index is contractually required to buy it, at whatever price the market happens to be at that moment. No analysis, no hesitation. Just buy. Analysts estimate the combined forced buying from NASDAQ 100 and Russell index funds could run somewhere in the tens of billions of dollars, landing on a stock with maybe $90 billion of actual tradable shares. Picture trying to pour a swimming pool's worth of water through a garden hose. That's roughly the physics here. A wall of mandatory buying hitting a narrow channel of available stock. And the people on the other side of that trade, the ones selling into it, are largely insiders who've been holding shares since SpaceX was worth a fraction of what it's worth today.
Now here's the piece that makes this genuinely interesting, not just another stock went up story. SpaceX's insider lockup doesn't release all at once either. It comes in stages. A first batch becomes sellable roughly 90 days after the IPO, then more in waves after that, tied partly to earnings reports. So line up the calendar in your head. First, the forced index buying happens. Mechanical demand, no choice involved.
hitting that tiny float, likely pushing the price up. Then, weeks later, the insider lockups start releasing. People who've held shares since the early days get their first real chance to sell. Forced buying first, insider selling second. I'm not going to claim that's some grand conspiracy. Index providers and corporate insiders aren't coordinating in a back room. But the structure of the rules creates that sequence, whether anyone planned it or not. Passive money shows up first and lifts the price. Insiders get their exit window right after. You don't have to believe it's intentional to notice it's convenient for one side of the trade.
Let's be specific about who sits where in this. The insiders bought in years ago at prices that look nothing like today's. Whatever happens to the stock from here, they're already sitting on enormous gains. Their unlock dates are circled on the calendar. The retail trader who bought SPCX directly on day one, they made an active choice. They saw the price, they saw the risk, they clicked buy anyway. If it goes well, that was their call. If it doesn't, that's theirs too. Then there's you. If you've got a 401k, an IRA, anything sitting in a broad index fund, you didn't make a choice at all. Your fund will own SpaceX because the rulebook says it has to, at whatever price the market lands on when that buying hits. Two people can end up holding the exact same stock. One of them chose it. One of them just had a paycheck deduction going into a safe, diversified fund for the last 5 years. That second person carries all the same risk, with none of the decision-making.
This isn't a new story, by the way. It happened, smaller scale, with Tesla back in 2020. When S&P announced Tesla was joining the S&P 500, the stock ran up roughly 40% in the weeks before it officially joined, as index funds had to scramble to buy in. Tesla went in at under 2% of the index. Then, after the buying wave finished, Tesla actually underperformed the S&P 500 for a stretch afterward. The mechanical demand had already done its work, and once it stopped, the stock had to stand on its own. Now compare the setup. Tesla, back then, already had years of trading history and a much bigger float relative to its size. SpaceX has about a week and a half of trading history, and over 90% of its shares still locked away. Smaller float, same mechanism. You can draw your own conclusion about which direction that points. Quick thing worth knowing, because it's the fairest comparison point in this whole story. The S&P 500, one of the 3 major indexes, did not rewrite its rules for SpaceX. It still requires a company to be profitable on paper for a full year before it qualifies, and SpaceX isn't there yet. So S&P 500 inclusion isn't happening on any fast-track timeline. If you're mostly in an S&P 500 fund, this particular wave doesn't hit your account directly. Worth sitting with that for a second. Not every index provider moved the goalposts. One of them looked at the same opportunity and just didn't. Here's the honest answer, and it's less exciting than financial Twitter wants it to be. Option 1. Try to dodge it by switching your 401k funds around. For most people, this isn't realistic. You usually can't handpick which stocks your default fund holds. Option 2. Try to front-run it. Buy SPCX directly now, ride the wave, sell before it cools off. This is the loud, exciting idea, and the Tesla precedent suggests it mostly works for the people who already got in before the news broke, not the ones piling in after. Option 3. The quiet one. Accept that your passive exposure is coming whether you like it or not, and just don't stack an active bet on top of a forced one. Let the dust settle. Let a few earnings reports happen. Let the lockup waves play out. Then decide, with real information, instead of index mechanics doing the deciding for you. That third option isn't thrilling. It's also usually the one that doesn't blow up in your face 6 months later. Here's what I actually want you to walk away with. You don't need to have an opinion on rockets or Mars or Elon Musk to understand what just happened to your money. You just need to understand that the rules governing your retirement account got rewritten this year, quietly, legally, and almost entirely unreported. And that rewrite is about to put a brand new, untested, wildly volatile stock into accounts that were never asked permission. The information was never hidden. The rule changes are public documents.
The float numbers are public. None of this was secret. It just wasn't loud. That's usually how the biggest shifts in your money work. Not hidden, just quiet enough that nobody's watching.
If this connected some dots for you, there's a part 2 to this story already up. We walked through SpaceX's full insider unlock calendar and a specific trigger clause buried in the IPO paperwork that most coverage missed entirely. It's called SpaceX IPO just went public. The real risk starts after 90 days. Link's right there if you want the rest of this picture. Subscribe if you want the next one of these the moment it drops. We're going to keep reading the documents nobody else is reading. See you in the next one.